Josh and Colton, I appreciate you guys joining us today. Let's kick it off with brief intros. Could you guys just tell us, let's start with you, Josh. Just tell us a little bit about your background and where you're at today at Figment.
Thanks, Mike. Appreciate you guys hosting this and excited to be here. So my name is Josh Deems. I look after the TradFi go-to-market strategy at Figment. So kind of thinking about like the future of who's going to be staking, and Figment is a proof of stake company. And we'll talk a little bit more about what that is and what that means. But I sort of look at like the traditional financial lens, the banks, the asset managers, the brokers, et cetera, who are going to be interacting with protocols, and really think about how they're interacting with those protocols and if there's a way for them to participate in staking. My background is, I think I'm on my 9th year in crypto, which is like kind of, I don't know.
OG.
Yeah, probably makes me, 100 years old in dog crypto years. But I previously worked at Fidelity, worked on the digital assets team there, building out custody and trade execution platform for their institutional customers. Before then, I was actually at State Street. When I found crypto, my first ever job, and it was at State Street, and we were working on some early iterations of kind of like what you're looking at today in terms of what's happening with tokenized real world assets and some like, DLT based solutions for tracking collateral. We worked on kind of early iterations of the Ethereum Enterprise Alliance. So it kind of went from DLT to more of a crypto native, but at Fidelity, sort of working on their institutional stuff. And then now at Figment, full blown crypto native world with an institutional lens.
Love it. Awesome. Colton, let's pass the mic over to you. Tell us a little bit about your background.
Sweet. Yeah. So I'm Colton Campbell. I'm on our sales engineering team at Figment, which basically means I work on a lot of the technical integrations for a lot of our leading exchanges, wallets, custodians, asset managers, those kinds of folks. And a lot of what that means is figuring out how staking works on a very technical level for a lot of the networks that Figment supports, and then building a customer-facing product around that. And so my background is both on the software engineering side. So I joined Figment actually as a software engineer a few years ago, and on the product management side as well. I think this is probably my 5th year in crypto at this point. I started off building smart contracts in Solidity. When I was in college, we built what was, at the time, when we started building at least, the first point of sale terminal to accept like ETH and ERC20s for payment for things like, a coffee shop, and you wanted to buy your coffee with ETH. The problem was that nobody actually wanted to spend their ETH back then. And it was like right when everything was taking off in like the 2020, 2021 cycle. So anyway, I ended up joining Figment instead. So here I am. And yeah, I'm looking forward to the rest of the conversation today.
Awesome. Appreciate you guys. Well, let's kick it off with a really basic question. What is staking? What does it mean?
Staking is a consensus mechanism. And it is, people will be familiar with proof of work on Bitcoin. It's the conversion of energy into compute, which allows you as a participant to mine new blocks, to add new blocks to the blockchain. And in reward for doing so, some of the newly issued Bitcoin and the transaction tips, some of the transaction tips or fees paid to transact on the Bitcoin blockchain end up accruing back to the person whose energy was used to solve that block. Now, proof of stake sort of takes that concept, but sort of changes the dynamic a little bit. So as opposed to contributing energy into what we call finality, settlement finality in the blockchain space, you can actually participate as a token holder in that particular token. So Ethereum switched from proof of work to proof of stake 2 years ago, which is actually a very, very big deal. Solana is a native proof of stake token, proof of stake blockchain. Tezos is actually, I think, the first what I would say like instance of proof of stake in use. And basically, if you own the token, you can delegate that token to that network in order to validate blocks. So as opposed to contributing energy, you're effectively locking up your tokens. Now you're not sending them to anyone else. You're not, redistributing them or sharing custody with someone else. You're just effectively staking those tokens to a validator, and that validator is helping solve puzzles also that end up leading into, kind of building blocks of transactions. And without that function, blockchains would just be kind of a mess of different transactions, and people would have a completely different view of like what the state of the network is. State being how much Ethereum I have versus how much Ethereum Colton has. It plays a very critical role in sort of organizing and validating transactions that are taking place. And in return, the real incentive is that stakers are earning the rewards. So rewards being, like I was saying, for Bitcoin miners in the Ethereum, Solana space, it's transaction fees. And there's also a couple of other ways that miners or that stakers are incentivized beyond a Bitcoin miner. And so they're earning, new network issuance, so network inflation, so newly minted Solana, newly minted Ethereum, on top of the fees, the tips that they're being paid to validate transactions. And each network has a very different way, has different inflation rates. They have different, transaction fees, transaction costs, different elements of that. But the average rewards rate that someone would earn is probably somewhere around 5 to 7%. On Ethereum, it's a little bit lower, about 3.5%. Things like Polkadot, it's really high, like high 20%. But really, that's the sort of the annualized amount that someone is basically earning from locking up their tokens, participating in settlement finality, and really, the trade-off between liquidity versus earning rewards. That's kind of how I think about it at a high level.
Yeah, no, that was great, Josh. I think the only thing I'd add to that is that when we're talking about staking in this context, we're talking about protocol staking. So this is you're holding a coin that's native to the blockchain you're interacting with, locking that coin up and pointing it at a validator who is validating the transactions, earning rewards, and is also susceptible to a concept called slashing, which I'll just touch on really quickly. But when we talk about validators and their role on these different blockchains, we say they're validating like the transactions and every block that comes in. But to a lot of people that may or may not make a lot of sense. So like at a high level, each of these validators is running the same or similar software. And what that software is doing is saying, these are the rules of the protocol. These are the rules of the blockchain. And they usually have a lot of common ones, like, if I have 5 SOL in my wallet, I can't send 6 SOL to Josh. If I sent that transaction to the blockchains, if I sent that to the Solana blockchain, a validator like Figment, for example, or maybe one of the other validators on the network would see that transaction, say, this doesn't agree with the software that I have running, so reject it. And then that would be a validator that's doing their job correctly. Now, a validator that could do their job incorrectly would be processing that transaction and saying it is valid on chain. Now, the benefit is that all of the other validators on a blockchain can see the transactions that each validator is like proposing. And so as long as everybody's running the same software and is not running something that's malicious, they should reach an agreement or like what we call consensus on the state of the chain. And so for doing all the processing, all that stuff, that's how you earn rewards. For acting maliciously or maybe even accidentally saying that the faulty transaction is valid, that's how things go wrong, and you either miss rewards or lose some of the staked assets that you've actually delegated to that validator. So
awesome, very very cool. Appreciate you guys giving me the explanation. One couple quick things. One, I think you brought up the rewards rate versus the inflation rate. Can you explain what? Obviously, the rewards rate is kind of the yield what people are getting. What is the inflation rate?
So there's really like three buckets of rewards on the Ethereum blockchain. Ethereum is like, not to get hyper specific, but there are sort of two layers to the Ethereum chain. There's the consensus layer and the execution layer, at least to the Ethereum L1. And the consensus layer is really just Ethereum. It's a deflationary protocol, right? There's a deflationary monetary supply, but there's still new Ethereum that are being issued to validators. That number fluctuates based on the number of validators that are participating in the network. But there's still new Ethereum that's being issued and paid to validators to incentivize folks to stake. Although that number goes down over time. It's the same thing as like Bitcoin having a limited supply of 21 million, and we're unlocking the final million, and then it happens through the mining process. So every block that gets mined or block that gets validated on the Ethereum blockchain, there is a payout to the validators in the form of newly issued Ethereum. Now, there's also a share of transaction fees and tips. Some of the transaction fees are burned, and that's really to maintain this deflationary state where you're not, completely inflating the supply of Ethereum. That would defeat the purpose of creating sort of like a non-sovereign, monetary store of value. But you do earn a portion of the transaction fees that are paid, and that is what happens on the execution layer. So the consensus layer is inflation and newly minted, which is basically newly minted Ethereum. Execution layer, a portion of the tips, the fees that you're basically, if someone in a fee is, I want my transaction to be sent to Colton more quickly. I'm willing to pay a little bit of a higher fee. A portion of that fee then goes to the validators that are processing that transaction. There's one component that's a little bit more technical called MEV, or maximum extractable value. That's what I would consider to be like the third bucket of rewards.
Back when Ethereum was proof of work, it was miner extractable value. But now that there's validators instead of miners, that no longer makes sense. But the idea is there is often profit to be made in the transactions that are happening in a block, and different actions on a blockchain. And like the most common like category of MEV that you'll see today is something that's called like like when you see like arbitration between one decentralized exchange and another. So like price differences. So if I have the ETH versus Sol trade on one decentralized exchange different from another, there's an arbitrage opportunity. And so what an MEV like bot could do is look for those discrepancies and try and make those trades, and they'll pay a higher fee to prioritize their transaction in a block. So that's kind of the fee that Josh is talking about right now. Obviously, the arbitrage opportunities don't last for a super long time, so they're going to pay a lot for their transaction to be first in the block. Another one is called
Liquidation,
right? So like in like DeFi protocols, you're going to post up, say like 120% of collateral for the loan that you're taking out, and if the asset that you have as collateral ends up valuing a lot less in comparison to the loan that you pulled out, you get liquidated. And the way that liquidation usually works is they'll have similar things. Like have these bots that are acting on chain, or these programs that are running to look at these liquidation opportunities and say, oh, this person is now under collateralized. Then I will buy that collateral and sell it for a higher price, and then make money off of that trade. And they usually get a fee from that as well. And then the last one is called front running, where on the vast majority of these blockchains, the mempool, or like the place that all these transactions will sit in before they actually get executed, you can actually see people's trades before they happen and before they execute on chain. So if I see that Josh has found his own profitable trade across 2 different decentralized exchanges, I can look at that while it's sitting in the mempool, copy it exactly, and just make it from my own address and pay with a higher fee, and then my trade will get executed first. And I'll be able to build a profit from it. So yeah, those are the types of MEV.
Colton and I co-authored a paper about different forms of MEV and some live examples, because it's kind of hard to like picture MEV actually happening. But there's some pretty amazing live examples of, like, if you look at the Ethereum rewards rate and days where Ethereum's rewards rate has spiked, it's obviously days with high amounts of MEV. And MEV values go up on days where there's demand for block space. So there's a lot of people competing to get their transactions placed at once. And so the 2 days that stick out in my mind as having like just a significant amount of these arbitrage opportunities from an MEV perspective. The first was in earlier August of this year, August 5th or 6th, I believe, when the yen carry trade unwound, and there was just a significant amount of over or under collateralized positions. There was just leverage wipeout in the system. People were trying to get out as quickly as possible to pay down, other buckets of collateral. There was a massive MEV opportunity, and so the Ethereum rewards rate shot up to like 18 or 19% overnight, which is an extreme outlier in terms of the average historical rewards rate. And the other is in March of last year, when Silicon Valley Bank blew up, there was a depeg of USDC, the stablecoin, to the dollar. And so our bots came in and they would buy USDC below $1 and sell it at $1 as long as that trade was profitable, which actually plays an important market function, brings USDC back to parity with the dollar. But they're paying, in order to be able to do that, because there is some profit in that trade. And so, we're going to see like an increase in MEV bots, these programs, on those particular types of days. But there's examples, definitely live examples of MEV and kind of reacting to things that are happening like in the macro environment, even outside of just the Ethereum ecosystem.
Yeah. And so relating that to staking rewards. So is that kind of just like the fee transactions that's included for these stakers?
Yeah, I think it's worth pointing out that there's only right now you see those MEV rewards going back to stakers only on a handful of blockchains, like most notably like Ethereum and Solana, because they have this notion called proposer builder separation, where a lot of the fees that are earned from MEV transactions actually go back to stakers. There are some blockchains where it's actually going to be all of the actual MEV bots that are going to take all the profits from this, but we're trying to make it less extractive to the rest of the network and driving rewards back to the stakers. So ETH and Sol both have, like on Ethereum you have Flash bots, MEV Boost, and on Solana you have GDO that's going to drive those rewards back to stakers.
Got it.
Mm-hmm.
Got it. Awesome. Yeah, I appreciate you guys breaking that down for us. Now, in terms of when it comes to like staking rewards, is it, how does the market kind of balance itself out? Like, is there, as more people stake their tokens, like, do the rewards become less? Is it divvied out to validators, just like, in the case of like Bitcoin with different mining pools? Maybe that's kind of 2 questions, but I'll let you guys take that out as.
Yeah, I mean, usually when you see these new blockchains launch, you have this, the common, like so Josh was talking before about how like your rewards are going to come from 2 places generally. One is going to be inflation, the other is going to be transaction fees. And so if a new blockchain launches, they're probably not going to have a ton of apps on the chain yet, which means there's not a lot to do. And so why would it be generating a ton of transaction fees? But in order to actually incentivize people to stake on that blockchain, what those chains will do is vote to have a higher inflation rate. And so you can see like crazy inflation rates where your APR for starting to stake in the first few months of a chain can be like, man, we've seen it up to like, I don't remember what Osmosis was back when Osmosis was huge, but like 150% reward rate. I think there was a point when it was like even a few hundred. But the point is, usually as a protocol is very early, a lot of this extremely high inflation rate. And then once people start building apps that become successful and the chain starts maturing, we'll see that inflation schedule start to taper out a little bit more. And so, yeah, I mean, a lot of these, when you look at like the tokenomics for these different blockchains, they'll have like written in their documentation saying like, okay, over, a 5-year period, this is what we're going to do to inflation. Like, obviously it can adjust through like governance votes and those kinds of things, but yeah, it usually starts often like absurdly high.
Most chains too, Colton, they have this concept of like, validators earning inflation plus transaction fees. And so, Mike, like the natural way to think about it is if a higher percentage of a network becomes staked, like there's an actual huge discrepancy between the percentage of Ethereum that's staked and the percentage of Solana. Only about 28% of Ethereum is staked, and Solana that's around 70-80%. So there's a huge discrepancy in like the amount of people that are participating in staking on both of those networks. Now, if Ethereum, reaches parity with Solana, and say Ethereum is some days in the future at 70 to 80% staked, we would expect the inflationary rewards would be split amongst more participants. So there would be less consensus layer rewards available to you as a validator. But if the 70 to 80% of the network is staked, then naturally, like it means a lot of people are using Ethereum or they're using Solana. And so, the equation for you as a validator or you as a staker is, okay, maybe my inflationary is kind of the more predictable stream of rewards goes down, but maybe my actual overall rewards rate goes up because people have demand to use these protocols. So it kind of feeds into the usage component, right? If network inflation doesn't increase because more stakers are participating, naturally, you're not going to earn as much. But if more people are using the network, then you could potentially offset that and then some, because people demand, transactions to be put through on your particular blockchain, and there's people competing, to send their transactions. So it increases the economic value of each transaction. Therefore, you as a staker may even potentially earn a higher rewards rate.
Yeah. And then I have two kind of quicker follow-up questions with this. When it comes to like running a validator, is this just, let's stick to like maybe Ethereum, Solana, like are these folks just running software, or do you have to have, kind of what are the requirements for running a validator?
So it'll depend on the network, but some of them, it's usually a validator software that you have to run in your own data center or rent space in a data center or something like that. But yeah, at the end of the day, it's software, and like I was saying earlier, it's for just about every chain outside of Ethereum and Solana. Every validator is going to be running the exact same software. Now, when you look at Ethereum and Solana, they're a little bit more mature on the proof of stake side. So they developed like multiple clients, or in other words, like multiple implementations of the same validator software. And the reason to do that is, if the validator software that everybody's running has a bug in it and the whole chain stops working, or maybe there's a fault, like I was talking earlier, maybe there's an invalid transaction that's broadcasted and finalized for whatever reason, that creates a huge issue. And so what the goal is on Ethereum and Solana is to have a good and healthy distribution across these different like validator client implementations. But yeah, sorry, I guess to answer your question perfectly, yes, it's software that people are running, that we're running.
And then the follow-up question I had on this is, does having more tokens being staked, does it make the network more secure, stronger?
Yeah, there's different functions that measure, how resilient a network is. But with Ethereum, Solana, with all of these majors, their security budget is effectively the amount of variance and stake to the network. And because those networks have a high percentage of people that are staking to it, specifically Solana, it does increase network security. So if you had a network that had a very low amount, like, maybe like, it doesn't have a high economic value, maybe only like 10% of the network is staked, it'd be very easy for you to spin up a validator, obtain a majority of the tokens and, the value in that network. And then you could sort of, make your own rules, right? Like kind of create value out of thin air, because you could just be processing illegal transactions or invalid transactions simply because you had a majority So yeah, maintaining decentralization is extremely important. If anyone takes a more of a centralized role, then obviously, that's kind of the major fears. That's when the rules start to become unwritten around, having these blockchains perform decentralized functions for transacting. So yeah, I think to answer your question, Mike, the more stake just equals the higher security budget, protecting bad actors from being able to reorg and execute invalid transactions.
Yeah, that makes a lot of sense. I guess you guys were talking about the validation side. I mean, from a staking perspective, as a staking provider, what's the strategy there? And maybe go into how does one go about staking, just from a general
Yeah.
perspective?
Proof of stake, protocol validators. We don't take custody of our customers' funds, right? You're not sending your tokens to Figment, so we need to be where our customers are at. Where are our customers are at? They're at exchanges, they're at custodians. They hold self custody. And we and we've really modeled our business to be B2B. So we are interacting directly with the institutional side, or the institutional side who directly hold tokens themselves, or the entities that they hold tokens through. And there are multiple different ways that someone can stake, right? There's the whole process of just spinning up a validator, delegating tokens to that validator, and then receiving reporting. Like, it sounds simple. There's a lot sort of happening behind the scenes that enable that to happen. But we sort of have a dual layer strategy. One is acquire customers directly. Like if you look at the list of largest Solana validators, Figment has two sort of well-known validators that are in the top 5. One is our own white label validator, and the other is a validator for Ledger. And so if you're like a Ledger customer, you can log into your Ledger Live account. You can stake, Solana directly to the Figment validator, the Figment Solana validator, for instance. So, that's like Figment's not actually going out and acquiring those end customers, but Ledger has relationships there. They market to institutions and to retail. So our job is to work with Ledger or work with the other large custodians, and then also with the larger institutions. And when we initially launched this business, there wasn't the early adopters from a customer perspective were truly like the venture funds that were owning proof of stake assets and willing to stake them. Now, we work with banks global, large traditional banks. We work with exchange traded products in outside the US. We work with asset managers, RIA platforms. It's really evolved since the early days of supporting a handful of VCs who own these tokens and were willing to self-custody them, to supporting dozens of different custodians, different geographies, having a team that's dispersed across North America, Europe, and APAC, because the custodians in each of those markets are different. So it's truly B2B, and from our perspective, and really, we're not ever taking custody of an end customer's token.
Yeah. I think even before touching on that, I think like there's a really important piece of staking that a lot of people kind of gloss over before deciding to stake, and that is, which asset are you going to stake? Some people forget, before you start staking, you're going to choose to invest in one of these assets first. And you obviously choose to invest in an asset because you think, well, okay, this probably doesn't look just like everything else. There's something special about this one. The blockchain works different. Maybe it has some specialization in data availability that you think is better than all of its competitors. And so with every blockchain being different, it's weird, but people don't expect staking to work in different ways for each of these different blockchains, but it does, unfortunately. So I think not only is it, I think the decision is, yes, I'd like to start staking this asset on this blockchain. And the next question is kind of like, how does it work? And so like the point of working with, like a custodian or like a staking provider is, having a helping hand there to help you navigate all of these different things and trying to help you make, decisions on, how should I look at optimizing my reward rate, or like what's kind of performance can I expect and what affects that kind of performance? How can I track the certain things that are happening on chain, whether I'm earning rewards or looking at my staking activity? making sure everything is like audit ready and all that kind of stuff, I think is a really important step before actually staking actually happens. So that's kind of like the meat of everything in between, like the decision to stake to the point of, assets actually being staked on chain. I've honestly seen plenty of times where in that process, people have changed their minds and been like, yeah, this is just not happening. It's way too complicated. Or maybe it's not, like, this doesn't work with our objectives as like a fund or something like that. Like maybe, you're not comfortable with like some of the smart contract risk. I mean, we haven't talked about things like liquid staking and restaking yet in this conversation so far, but like there are things that people just aren't really comfortable yet because, maybe it's really new or confusing. So I think that's another thing that, like, working with custodians and staking providers is really a huge help. We're really trying to make things a lot simpler. And I think to add on to that, like, once you're trying to figure out which asset to support, you have to find your service providers that are both going to support. You have to find service providers that are also going to support what you want to do for that asset. So you need to find a custodian where you can hold those funds. And like, there's not a whole lot of overlap between all these different custodians and the assets they support. Like, obviously they'll support the big ones like ETH, Sol, and all of the other like largest proof of stake assets that you want to stake. But once you start, advancing and expanding into other assets, it becomes a little bit more sparse. And then you also have to find a staking provider, somebody like Figment or one of our competitors that also supports staking for that asset. So some of those things. And then the reason why that's so hard to like actually navigate is because each of us, staking providers and custodians, have to figure out how these things work ourselves. So, building staking transactions happens on, different ways and different chains. You have to use different libraries that upgrade all the time. So you're managing upgrades. Like, this is a technical problem that happens all the time.
That makes sense, because that was you're actually going to kind of answer my next question, which is why doesn't big custodian just spin up their own validator?
Yeah, they totally could, and we've definitely seen it in the past. And the like internal joke is like, we've approached a lot of these like custodians early on, before like we formed a lot of these partnerships, and they're like, we're a crypto company, we should be able to run validators, and like, by all means, everybody should. It's open, it's open source, it's all permissionless. Like, everybody should be able to run their validator, and we like absolutely support it. But to become specialized in running validators is a challenging thing that some people want to focus on building an institutional custody platform. And if they want to do that and partner with a staking provider, the returns might be a lot more than they expect. But yeah, I think a lot of it is, the technical burden of dealing with, a massive DevOps team and like just the craziness of running always on software for blockchains.
Yeah. I think the other advantage, Colton, to like working with the service provider is, we sign agreements with our end customers. Our customers are working with us because we've gone out and secured like coverage from a, globally recognized insurance provider. Like, we have reporting capabilities that are natively built in that can be delivered via API or through a dashboard. And so like, if you're just natively staking on your own, you're not getting in any of those features. And those are like you always hear like tax reporting or tax season is probably the hardest thing to do in crypto. And without having like record of the date and time and, block height that you've earned rewards at, it's just gonna make, that much more difficult to track. Or if there were to be, kind of a mass slashing event on a blockchain like Ethereum, having a service provider who has coverage policy that can be, used in certain situations, like it definitely, gives larger institutions comfort. And I think like Colton was alluding to the sheer size of number of people that needs to focus on something like this. Like, we're very lucky and fortunate at Figment. We have about 150 people, and the majority of those people, our most undersized team is our go-to-market team. The majority of the people that work at this organization work on protocols, they work on DevOps, they work on operations. And so, the majority is like making sure that, if we don't exist, like these blockchains, it's just, again, we're talking about security budget, but like there's a lot of security budget that goes away if we're not doing our job properly. So I think if you're a custodian or you're an exchange, it's great to work with the staking provider, but it is like fairly specialized in like the way that you're operating these behind the scenes. I've sat in on our DevOps calls. I've seen our DevOps team live in action, and it's actually pretty amazing, and not something, a custodian's job is to protect the security of the underlying assets. Staker's job is to maintain, the integrity of the blockchain, and also make sure that your customers aren't getting slashed. And that's a pretty big responsibility in and of itself.
There's one thing I wanted to tack onto that is even for these custodians that offer staking to multiple validators or multiple staking providers, there's often going to be performance differences in a lot of these different providers as well, material performance differences. On some chains there really aren't, like Ethereum. Everyone oddly enough behaves over the long term very similar, and I'm saying everybody, I mean the validators, but on chains like Solana and Injective and a lot of Cosmos chains, there's going to be pretty material performance differences that make people want to work with, one provider over another.
Say more on that. What kind of performances are you talking? Is it 3% versus 4%, or
Well, I mean, so it depends on what time period you're looking over, but we've seen things over at 50 bips in terms of performance difference. Which if you're staking a large amount, that's a lot of money to be looking at what we're in a year.
And what causes that difference?
There's a lot of things. I mean, the number one thing that can go wrong for staking on these chains is this concept called slashing, which I was talking about earlier, which is a validator misbehaving or validating a poor transaction, or an invalid transaction. And that can actually result in the collateral, so the staked assets, being taken away. So that would result in a huge, obviously negative rewards rate. There are times where, sometimes people will, or validator staking providers will just have low uptime. Maybe there wasn't the right monitoring in place and they were down for too long. Maybe the staking provider isn't putting, their servers in the right places, or isn't running the right, MEV, or isn't running MEV software, for example. Some of it is definitely luck. On Ethereum, Josh and I were talking about these execution layer and MEV rewards. Those more or less are kind of luck of the draw. If your validator randomly gets voted on to propose a block, and there happens to be a day the day the yen carriage rate unwound, then that's awesome. But it's not necessarily your staking provider or your staking provider's win there. It's just kind of luck of the draw. But yeah, there's definitely some differences.
Yeah, very interesting. You both bring out some interesting points here. I'm curious from talking more about risk and challenges relative to the types of clients you guys have. There are certain nuances based on maybe it's an ETF or RIA that has certain challenges. Is there nuances based on the type of client you're working with, or is it all relative just to the ecosystem? I'm just curious kind of what you guys have seen based on, you're talking to various different clients, as you mentioned, and opportunities. Where are some nuances that you're saying, or challenges, or things to think about? Maybe I'm an ETF and I need to think about certain aspects of staking, or maybe from the RIA. Custody is one aspect, but just curious from your guys' lens.
I think the biggest thing that we've seen, I mean, and we work in a creative space, so if there's a challenge, there's certainly people that are willing to find a solution for it. So I'll caveat all of these with, there are absolutely solutions for these problems that are either in beta or being talked about and developed. ETFs pose a really interesting challenge, especially on Ethereum, because the staking settlement timeline of Ethereum. So if you stake a validator and then you want to unstake that validator, that's a sort of a moving target based on the amount of activity in the amount of other validators that are wishing to stake or unstake. There's sort of an activation queue. And so if I'm an ETF provider and I have 100 Ethereum staked, and I get, someone unsubscribes from the product, they redeem and and I owe delivery of Ethereum back to that person, or obviously oversimplifying the ETF flow here, then I need to unwind or unbond that Ethereum and either sell it for cash and deliver them the cash, or send them that Ethereum. That's not going to match the security settlement timeline. Security settlement T+1 or T+2, the trade day plus 1 day or trade day plus 2 days, depending on where you are in the world, that's not always going to match the Ethereum unbond timeline, right? The Ethereum unbond might be, 4 days, 5 days, 9 days. We saw like crazy amounts around when the merge actually happened, like over a month to stake a validator and then to unwind a validator or unstake a validator. So there are like unique solutions that people are coming up with. Colton sort of mentioned liquid staking earlier. We can get into that in a bit, but liquid staking is a way to earn majority of rewards on a protocol like Ethereum, but you get a receipt token, and that token can be used to pay for things or to transact in something that resembles the value of the original asset that may be staked. There's like the traditional finance way, which is you use your staked balance as collateral. You receive a loan out against that collateral, use that loan to settle the transaction with the end customer or the redemption. There's always just the concept of only staking a portion of the assets in the portfolio as well. And that's, obviously something that's not the best customer experience, at least in terms of the rewards generated, but you're usually able to meet liquidity requirements if you're not staking 100%. So I think we'll see like more on-chain solutions for that develop, especially if we get staking in ETFs in the US within the next year. Definitely will be something that customers will be demanding. I think that like liquidity tends to be a nuance, Skylar. Obviously, like risk management, I think most people are fairly comfortable with the risks of staking. It tends to just be an opportunity cost around liquidity. Is the 3 to 5 to 7% enough for me to lock my tokens and not be doing anything else with them? And that's kind of where liquid staking gets born out of, which allows you to kind of have your cake and eat it too. But really the main decision that we see institutions make is around this concept of liquidity and is the reward worth locking your tokens up? And for the majority of them, obviously, the answer is yes. Contribute to the security of the protocol, earn some of the transaction fees, and you're a lot of the other stuff that gets further out on the tail gets riskier and riskier. So it seems to be like the risk-free way to earn rewards on that native protocol.
That makes sense. Yeah, and just real quickly from people watching this, I mean, from a lockup perspective, what's the timeline for locking up a token or staking? What can be variable? What do you guys see? What just for people who haven't?
It's one of those fun things that actually differs chain by chain. So like Solana is like 2 or 3 days, 3 days. It can vary a little bit. Ethereum is minimum a day, and we've seen it get up to 40 days in times of like mass exodus from the set for validators. On a lot of Cosmos chains, it's like 21 days. Polkadot's 28. 7 days on some chains. It's all over the place. But I mean, like to Josh's point, like on these, like on a lot of these chains where it takes multiple weeks to unbond, a lot of people have a hard time trying to find liquidity solutions to that. So oftentimes, liquid staking is a great way to meet those requirements.
On Figment's website too, we can certainly direct people there after this. We have like a list of all the tokens and the unbonding time and the expected rewards rate. So people who like are planning for liquidity purposes can sort of use that as a guide.
Yeah, that's definitely helpful. We'll definitely include that in the show notes. In terms of you touched on the topic a little bit, but let's kind of dive into it. Restaking. What does that even mean to start?
We're talking about staking so far, which is taking the asset that is native to a chain and locking it up, pointing it at a validator to secure that chain and earn rewards. Now, another thing that we touched on was how when a lot of these chains are very brand new, maybe their token price is very low and they have very few validators or not a lot of stake on the network. That creates an issue where somebody could buy up the token and run the validator and actually have over like a majority of the network staked on their validator or number of validators, and thus take down the network far more easily than they could for a more mature network where it takes a lot more coordination with other existing incumbent validators. And so we call that like the cold start problem for brand new blockchains. Now, the idea with restaking is where you're going to take one asset, and so like the big buzz of this whole year so far, the number one name that we've heard is Eigenlayer, where that has brought restaking to Ethereum, where you take your ETH on the Ethereum chain, you lock it up and point it to one of Eigenlayer's smart contracts, and then you can choose an operator, which is synonymous for a validator, that is securing multiple other blockchains that are brand new and want to use the staked ETH, or in this case, the restaked ETH, as their own security. So as a token holder, that means you're staking one asset and earning rewards in several different assets. You're securing multiple different chains on top of the native chain that you're staking. And, all else equal, hopefully that means more rewards for the token holder. But, further down the road, it also means more risk because you're open to more penalties as your validator could misbehave. You have more opportunities for a validator to misbehave if it's validating more chains, just statistically. And we've seen this before. Eigenlayer is huge this year. Has I think I checked earlier today, it was like 20 billion USD in TZL, which is huge. But these, restaking is not a brand new concept. It's shared, this idea, the other word for restaking is shared security. We've seen that on Polkadot before with parachains and the relay chain. We've seen it in Cosmos with interchain security. But this most recent year, it's been brought to Ethereum, and even now it's being brought to Bitcoin with protocols like Babylon.
Bitcoin staking, but before we do that, is there like potential for like collateral risks? Like, is that something that you see or have seen?
Yeah, so one, it depends on implementation, right? So the point where this can get really bad is if the amount of stake on the underlying chains that are being secured. So if I have like 32 ETH and the amount of stake on a lot of the other chains that I'm securing surpasses the value of the amount of ETH that's been restaked, that means there's not enough economic security to share to these other chains. So if, say there's say for simplicity, there's $100 billion of ETH restaked, and these chains that are being secured by this restaking protocol have $120 billion of assets being staked. Then and pretending a black swan event, all of those chains have like a massive slashing event and need to slash $120 billion worth of assets, but there's only $100 billion worth of ETH to slash. That becomes an issue because you're essentially, there's $20 billion of a hole missing there. Obviously, that's worst case scenario, and you can get a little bit more creative in implementation if you are one of these restaking protocols and say, okay, as a restaker, you can designate I want 20% of my restaked ETH to go to securing these protocols. And so then you hit an upper limit at some point. So yeah, there's a risk there, but again, I think these things are being, we've been very close with the Eigenlayer team and a lot of these other restaking protocols recently. And so they're working through these things. They're extremely intelligent teams from all over in terms of existing crypto experience and academia and such. So it's a known problem.
Let's use that now to transition to, you mentioned Bitcoin staking. I'm kind of curious, about that aspect.
So the major protocol that at least so Colton was talking about Eigenlayer. Eigenlayer is restaking on top of Ethereum. Restaking on top of Bitcoin is through a layer called Babylon chain. And this is a team primarily out of Stanford. And they're basically developed a way to use the shared security model that Colton was talking about and apply it to other chains while using Bitcoin's shared security. Bitcoin being the largest crypto asset, the most long outstanding, while also having the largest security budget. It's I haven't done the exact math. I'd done this years ago, but it's just an exceptionally large amount, like a nation state, multiple coordinated nation state amount of their entire GDPs to attack the Bitcoin blockchain. So if you were, starting a new chain and you wanted to outsource security and you didn't know where to get started and you needed to get like a network effect of people using your blockchain in order to generate that security, you could use something like Babylon. It's just basically outsourced Bitcoin security. And then the pitch back to Bitcoin holders is you can non-custodially, so no transfer of custody, earn rewards for staking your Bitcoin, which really hasn't existed to date. There is another protocol called Stacks, which is a layer on top of Bitcoin where you can stake your stacks and earn Bitcoin. Babylon's a bit different. You start by owning Bitcoin, you stake your Bitcoin, and you earn right now points, which we can talk through what those technically are. But in the future, BBN, which is the Babylon token. And then there's going to be this whole layer of restaking and services that are built on top of Babylon that people will just, you want to have a liquid restaked representation of Bitcoin that, has some sort of peg to the price of Bitcoin and pays rewards. That's pretty cool, right? You're generating liquidity on top of staking your Bitcoin while you still maintain some level of peg back to the price of Bitcoin. There are projects out there like Lombard that are developing this. So we think it's going to, the real outcome here is it's going to unlock DeFi for Bitcoin. And it's not going to be using the Bitcoin base chain as like the initial settlement layer because it's expensive, right? So you do all of this activity and then you settle, in increments back to the base chain. So you're not paying a fee. A fee to transact on Bitcoin is much heavier than a fee to transact on a proof of stake chain. And so we think that'll unlock this user or holder of Bitcoin that wants to use it. They want liquidity against it. They want to participate in some of these DeFi protocols and earn additional rewards. I think we're just going to see a myriad of different use cases. Maybe some miners who have working capital requirements and they can forecast out what those working capital requirements are much more easily, knowing that there is a cash flow associated with their Bitcoin holding. And so I think it's going to. We've seen a lot of interest and demand for it. I think we're very excited about Bitcoin as a stakeable asset. It obviously, is a major change to the total addressable market of our business, given it's not a native proof of stake asset. But there's certainly a lot of interest, especially as the Babylon project is nearing only being a year old and has not fully launched into mainnet yet. Certainly large investors that want to participate.
Anything happening in the meme coin world with staking?
Solana has absolutely ripped this year because there's been so much DeFi activity. So many freaking people are launching these meme coins on things like Pumped
Some
Up.
good ones out there.
And Jupiter and Radium, all those things. And it is the rewards rate on Solana. Like people look at whether they want to stake. This is one of the things you think about. Like, okay, I want to stake my ETH or my Sol first. We have allocations in both. You look at the reward rate for Solana; it's more than twice that for staking, and a lot of that is due to people launching and trading these meme coins on Solana. And like whether or not you want to take that seriously because they are literally meme coins, there's something there. And I think. If nothing else, it's fun.
It definitely, yeah, it's kind of funny to have a conversation with like an institution, and they're asking you what influences the rewards rate and obviously usage. And they're like, okay, what are some examples of usage? And you're like, well, there's DeFi activities, there's stablecoin usage. Stablecoins obviously are used on top of Solana. And then like printing and trading meme coins, like people are willing to pay to do that kind of activity. And
Right.
so yeah, that generates fees that end up accruing back to the validator and the staker. So it is all just a part of like the activity happening on top of the chain, which I think is like a beautiful part of the decentralization of it. We don't like it's just like a cultural revolution happening on a blockchain, and you as an institution may not care at all, but you might own some Solana and stake it, and in some way, shape, or form, it ends up benefiting you. It's kind of just like, I think, a bit comical the way the wheel works there.
Yeah, absolutely. It's interesting, right? Never a dull moment. It's pretty exciting to see where things are changing and so fast. I'm curious from your guys' perspective. future of staking, and obviously a few changes you're talking about here, which is pretty exciting. Anything else that you see as a catalyst or things that are changing moving forward as you think, a year from now, 5 years from now? It's probably too far to think in this space.
A couple of protocol upgrades happening. Things that we're keeping an eye on. There's an Ethereum protocol upgrade happening next year. That's right now, I think, I'm not even sure if we mentioned this, but each Ethereum validator can only be funded with 32 Ethereum. There's an upgrade happening that's substantially increasing the amount of Ethereum that can be held in one validator. So that'll, from a liquidity management perspective, rather than like unstaking and restaking a bunch of different validators, you can earn rewards just by holding one. There is some, there's people are talking about different changes happening to the Solana blockchain, potentially adding in things like slashing, which would make it more important to use like an institutional grade staking provider, someone like us. I think those are like at the protocol level. I think the macro trends that I'm looking at, and I'm sure Colton has like way more exciting technical things than mine. But at a macro level, I'm really curious to see what happens in the next 12 to 18 months to see if we get staking in exchange listed products in the US. Obviously, like the Ethereum and Bitcoin ETPs from an investor perspective or even just an asset manager perspective, some of the most exciting product launches that have ever happened in the product category. And the Ethereum products don't have staking today. And so potentially under, a new SEC that's going to look at Ethereum and what like the manifestation of holding Ethereum is in an investment product also includes the concept of staking. And so, hopefully that's something that gets pushed forward under the agenda of the next SEC chairman. And I think once we have that, then, I think the narrative completely changes. You have, retirement accounts that then have exposure in the US to staking rewards. And that's just that's kind of putting this industry in a completely new echelon in terms of a success metric. So I'm looking at ETPs and ETFs in the US, staking becoming a component, because I want Ethereum rewards in my retirement account.
I think we're really excited about Bitcoin staking. Partially because I think from like a technical perspective, it's very interesting that, a lot of these protocols have actually figured out how to make that possible, especially in a way that's not custodial. The Bitcoin stays in your wallet while you're doing it. I think those are two like very important, it's a very important aspect of staking that is being brought to Bitcoin. The addressable market there is gigantic, like nothing we've ever seen before. It's, everybody holds Bitcoin. That's a crypto investor. Allowing them to stake it and earn rewards, whether it's through multiple other protocols or somebody figures out other ways to do it just on Bitcoin. Like I think that's pretty huge. There's other interesting things with, we saw Unichain launch, or the launch of Unichain coming up soon. I think some of these DeFi protocols and are going to start launching their own chains and make those assets stakeable, and potentially make it possible for the activity on their apps to financially benefit the holders and stakers of that asset. Obviously we'll see how things shake out with the election results, but I think we're pretty bullish on those kinds of things happening. And I think like there's this thing we've been saying recently, just with like the Bitcoin staking being possible. And we used to joke about people coming to us and asking to stake their Bitcoin, and like how that was just such a silly, for us it was like kind of a silly question. Now it's possible. Being able to restake your assets and secure multiple chains, that's weird. So I think staking is going to continue to get weirder over time. But that being said, a lot more exciting. You're going to be able to do a lot more things with it. People are, restaking USDC. So like, being able to earn on your stables is pretty important. So yeah, biggest one I think for me is probably Bitcoin staking.
Awesome. Well, I appreciate it, guys. It's a good spot to wrap up. Josh, Colton, really appreciate having you guys on. Where could people go to connect with you guys and learn more about Figment?
Figment.io, and that's Figment, like a figment of your imagination.
I'm on Twitter or X at Josh_Deems.
I'm on LinkedIn as Colton Campbell.
Very cool. Yeah. Well, this has been great, guys. We'll make sure to include all that in the show notes as well.